What if I told you inflation, stock prices, and corporate profits are no longer driven only by interest rates or demand, but by algorithms you never see? While investors debate earnings and central bank moves, imagine a world where your online order arrives faster every time and store shelves are never empty. This isn't magic. It's the unseen hand of AI silently rewriting the rules of global supply chains. We're about to expose how these powerful algorithms have transformed the very backbone of our economy, from unpredictable chaos to hyper-optimized precision, all while you weren't even looking. AI has quietly taken control of global supply chains, deciding what gets produced, shipped, delayed, or priced higher. These unseen systems now influence cash flows, margins, and even market volatility. This isn't a tech upgrade, it's a financial rewiring of the global economy. And the biggest risk? Markets are pricing the gains, but not the consequences. The unseen algorithms, how AI rewrote supply chains. Overnight. We're dissecting how AI's unseen algorithms have fundamentally rewired global supply chains, enabling unprecedented agility and resilience, or conversely, creating new points of systemic vulnerability. The focus is on the silent revolution that transformed logistics from a human-driven endeavor into an autonomous, data-optimized network. Point 1. AI turned supply chains into financial instruments. For most of modern economic history, supply chains were treated as a back-office function, necessary, complex, but fundamentally operational. Finance focused on revenue growth, cost-cutting, and capital structure, while logistics was seen as a cost center to be managed, not a strategic lever to be monetized. Artificial intelligence has completely shattered that separation. Today, supply chains operate less like warehouses and trucks and more like financial instruments, engineered to maximize cash flow, stabilize earnings, and quietly reshape corporate valuations. This shift happened without headlines, but its financial impact is profound. At the core of this transformation is AI's ability to predict demand with extreme precision. Machine learning models ingest vast streams of data, consumer behavior, seasonality, macro indicators, weather patterns, and even social sentiment, to forecast what will sell, where, and when. From a financial perspective, this changes everything. When demand is predictable, inventory no longer needs to sit idle on balance sheets. Companies can slash excess stock, shorten inventory cycles, and free up massive amounts of working capital. That capital, once frozen in warehouses, now flows into growth, buybacks, debt reduction, or higher returns for shareholders. AI also transformed pricing power into a dynamic financial tool. Instead of static pricing strategies, algorithms now continuously adjust procurement costs, shipping routes, and selling prices in real time. When raw material prices fluctuate or transport costs spike, AI absorbs the shock by re-optimizing the entire network instantly. This protects margins in a way traditional hedging never could. In effect, AI functions like a live risk management system, smoothing earnings volatility and making cash flows more predictable. Two traits financial markets reward with higher valuations. The impact extends directly into core financial metrics. Faster inventory turnover improves return on assets. Lower working capital requirements enhance free cash flow. Reduced operational uncertainty decreases earnings surprises. Over time, these changes alter how analysts model companies and how investors price risk. Two firms with identical revenues can command vastly different valuations if one runs an AI-optimized supply chain and the other does not. The market may call it operational excellence, but financially, it is a structural advantage. Perhaps the most important shift is how AI has converted logistics decisions into capital allocation decisions. Algorithms now determine when to produce, where to store, and how fast to move goods, all with the explicit goal of financial optimization. These systems effectively decide how much capital a company needs to function and how efficiently that capital is deployed. In many cases, executives no longer ask whether a supply chain decision is operationally feasible. They ask whether the algorithm confirms it improves cash flow and margin stability. What makes this transformation especially powerful and dangerous is its invisibility. Investors see improving margins and stronger balance sheets, but they rarely attribute those gains to AI-driven logistics intelligence. As a result, the market often misprices both the upside and the risk. Supply chains are no longer passive pathways for goods. They are active financial machines. And in a world where algorithms now sit between production and profit, understanding supply chains has quietly become a prerequisite for understanding modern finance. Imagine a world where your online order arrives faster every time, and store shelves are never empty. This isn't magic. It's the unseen hand of AI silently rewriting the rules of global supply chains. We're about to expose how these powerful algorithms have transformed the very backbone of our economy, from unpredictable chaos to hyper-optimized precision, all while you weren't even looking. Point 2. Algorithmic logistics and the new shape of market volatility. For decades, financial markets treated supply chain disruptions as external shocks, unpredictable events that caused sudden spikes in costs, shortages, and price instability. A port strike, a natural disaster, or a geopolitical conflict would ripple through markets, driving volatility in commodities, shipping stocks, consumer prices, and corporate earnings. Artificial intelligence promised to tame this chaos, and in many ways, it has. But in doing so, AI didn't eliminate volatility. It reshaped it, creating a new and less understood form of systemic financial risk. AI-powered logistics systems now monitor the global economy in real time. They track shipping congestion, fuel prices, weather systems, labor availability, trade policy signals, and demand fluctuations across regions. When disruption appears, algorithms respond instantly, rerouting cargo, switching suppliers, reallocating inventory, and adjusting pricing strategies. From a financial perspective, this has dramatically reduced short-term earnings shocks. Companies appear more stable, margins smoother, and quarterly results more predictable. Markets interpret this as lower risk, rewarding firms with higher multiples and cheaper access to capital. However, this stability is deceptive. When many companies rely on similar AI models, trained on similar data, and optimized for similar outcomes, their responses to stress become synchronized. Instead of reacting differently to disruption, firms move in the same direction at the same time. This herding effect compresses volatility during normal periods, but amplifies it during extreme events. In financial terms, AI acts like a volatility suppressor, until it suddenly becomes a volatility accelerator. The consequences are already visible in commodity and freight markets. Price movements that once unfolded gradually now remain stable for long periods, then break violently when algorithms collectively revise forecasts. Shipping rates, energy prices, and key inputs can stay artificially calm, masking underlying stress before adjusting sharply in days or even hours. For investors and risk managers, this creates a dangerous illusion of control. Traditional volatility indicators fail to capture the buildup of hidden pressure inside algorithmically managed systems. Another financial implication lies in correlation risk. AI-driven supply chains tightly link operational decisions across industries and geographies. A disruption in one node, such as a semiconductor shortage or a logistics platform outage, can propagate rapidly across multiple sectors. Earnings surprises no longer remain company-specific. They cluster. This raises systemic risk, particularly for diversified portfolios that assume low correlation between industries. In an AI-coordinated world, diversification provides less protection than models suggest. Central banks and policymakers are beginning to notice. Inflation data, inventory levels, and logistics metrics are increasingly intertwined, and AI's role in smoothing or amplifying these variables complicates monetary policy. When supply-driven inflation is delayed by algorithmic optimization, policymakers may respond too late. When AI-driven adjustments suddenly release pent-up pressure, markets can experience sharp repricing. The result is greater uncertainty, not less, at the macro-financial level. In essence, AI transformed logistics into a market stabilizer during calm periods and a shock amplifier during stress. Investors are pricing in the efficiency gains, but underestimating the tail risk. Market volatility hasn't disappeared. It has gone underground. And when it resurfaces, it does so faster, broader, and with far greater financial consequences than the old human-driven supply chains ever produced. Point 3. How AI-driven supply chains are quietly reshaping. Inflation. Inflation is often framed as a monetary phenomenon. Too much money chasing too few goods, controlled by interest rates, liquidity, and central bank policy. But beneath this financial narrative lies a more mechanical truth. Inflation is deeply influenced by how efficiently goods are produced, moved, and delivered. Artificial intelligence has entered this space as a powerful, largely invisible force, quietly altering inflation dynamics in ways traditional economic models struggle to capture. In many sectors, AI-driven supply chains have become a shadow monetary policy, influencing prices long before central banks react. AI's most immediate inflationary impact comes from its ability to reduce friction. By forecasting demand with precision, optimizing transportation routes, and minimizing idle inventory, AI lowers production and logistics costs. Fewer bottlenecks mean fewer shortages, and fewer shortages mean less upward pressure on prices. In this sense, AI acts as a deflationary force. It compresses margins where inefficiencies once allowed prices to rise, stabilizing consumer costs and smoothing price volatility across time. This is one reason inflation in certain goods categories remains muted even during periods of strong demand. However, this deflationary effect is conditional and fragile. AI-driven systems rely on continuous data flows and stable assumptions. When these assumptions hold, prices remain stable. When they break, inflation doesn't rise gradually, it spikes. Supply disruptions that AI cannot anticipate or correct quickly, such as geopolitical shocks, regulatory shifts, or sudden data failures, cause rapid price adjustments. The same algorithms that suppress inflation during normal times can amplify inflation during stress by triggering simultaneous price increases across entire networks. This creates a new inflation pattern: delayed, compressed, and abrupt. Instead of slow-moving price trends, economies experience periods of artificial calm followed by sharp inflationary bursts. For policymakers, this is deeply problematic. Central banks operate with lagging indicators, while AI operates in real time. By the time inflation appears in official data, algorithmic supply chains may have already repriced goods aggressively, forcing policymakers into reactive and potentially destabilizing interventions. AI also changes how inflation is distributed. Rather than broad-based price increases, inflation becomes localized and uneven. Some regions and product categories remain stable due to optimized logistics, while others experience sudden shortages and price jumps due to algorithmic prioritization. From a financial perspective, this distorts inflation expectations and complicates wage negotiations, bond pricing, and long-term contracts. Investors relying on aggregate inflation data may misjudge real purchasing power risks. Another underappreciated factor is pricing automation. AI increasingly controls not just costs, but final pricing decisions. Dynamic pricing algorithms adjust prices based on inventory levels, delivery speed, and demand forecasts. This means inflation is no longer purely reactive. It is actively managed. In some cases, companies may preserve margins by allowing small, frequent price increases that escape consumer attention but accumulate over time. Inflation becomes smoother in appearance, but more persistent in reality. The deeper implication is that inflation is no longer governed solely by monetary policy or market forces. It is partially engineered by algorithmic systems optimizing for efficiency and profit. This shifts power away from traditional economic institutions and toward private, opaque AI models. As a result, inflation has become harder to predict, harder to measure, and harder to control. AI didn't eliminate inflationary pressure. It changed its rhythm, its visibility, and its financial consequences. Point 4. The new corporate divide: AI-powered winners and AI-dependent survivors. Artificial intelligence did not create a level playing field in global supply chains. It fractured it. What emerged is a sharp and widening corporate divide that financial markets are only beginning to understand. On one side are companies that own, design, and control their AI-driven supply chain systems. On the other are firms that merely rent access to third-party platforms. This distinction is no longer technical. It is financial, strategic, and ultimately existential. AI-powered firms treat supply chains as proprietary assets. Their algorithms are trained on exclusive historical data, customized workflows, and firm-specific risk tolerances. Over time, these systems compound their advantage. The more they operate, the smarter they become, continuously refining forecasts, pricing strategies, and logistics decisions. Financially, this translates into predictable margins, stable cash flows, and stronger pricing power. Markets reward this control with higher valuation multiples, lower cost of capital, and investor confidence in long-term resilience. In contrast, AI-dependent firms rely on standardized platforms built by logistics providers, cloud vendors, or software giants. While these tools offer efficiency, they lack differentiation. Everyone using the same algorithm receives similar recommendations, reacts to disruptions in the same way, and competes on the same operational logic. This erodes competitive advantage and exposes firms to hidden concentration risk. If a platform changes its pricing, suffers downtime, or updates its model, thousands of companies are affected simultaneously. From a financial standpoint, these firms carry operational risk they cannot price or hedge. The divide becomes most visible during periods of stress. AI-powered firms can reprogram priorities, override automated decisions, and allocate resources strategically. AI-dependent firms must accept whatever optimization the platform provides, even if it harms their margins or market position. In earnings calls, both may cite supply chain challenges, but investors increasingly recognize that one group adapts, while the other absorbs damage. Over time, this divergence compounds into market share shifts and persistent valuation gaps. This divide also influences capital markets behavior. Lenders and investors favor firms with proprietary AI infrastructure because their earnings volatility appears lower and their downside risk more controllable. Credit spreads narrow, equity valuations rise, and access to funding improves. Meanwhile, AI-dependent firms face greater scrutiny, higher financing costs, and reduced tolerance for earnings misses. What looks like a technology choice becomes a determinant of financial survival. Perhaps the most dangerous aspect of this divide is its invisibility. Financial statements rarely disclose the depth of AI dependence or ownership. Two companies may report similar margins and growth, yet one controls its supply chain intelligence while the other leases it. In a crisis, this hidden difference can trigger sudden revaluations as markets reassess which firms truly control their operations. In the long run, this dynamic reshapes entire industries. AI ownership consolidates power, favors scale, and raises barriers to entry. Smaller firms become structurally dependent, not inefficient, but subordinate. Supply chains no longer just move goods, they determine who captures value and who merely participates. In the AI era, control of logistics intelligence has become a defining financial moat, and the gap between the owners and the dependents is only widening. Point 5. Systemic risk. The financial cost of invisible control. The final and most dangerous consequence of AI-driven supply chains is not inefficiency, inflation, or competition. It is systemic risk that markets are not pricing in. Supply chains have quietly become part of the global financial infrastructure. Yet, unlike banks or payment systems, they are not stress-tested, regulated, or fully understood. A single dominant AI platform now influences thousands of companies, millions of transactions, and trillions of dollars in economic activity. When such a system fails, the damage is not operational. It is financial contagion. Unlike traditional disruptions, algorithmic failures spread at machine speed. A flawed forecast, corrupted dataset, cyber attack, or misaligned optimization objective can simultaneously trigger shortages, delivery delays, and price spikes across multiple industries. Earnings collapse together, credit risk rises together, and markets reprice together. This is the definition of systemic risk, highly correlated failure in systems assumed to be independent. What makes this risk uniquely dangerous is its opacity. AI decisions are often black boxes, protected as intellectual property. When something goes wrong, companies may not even understand why their supply chains failed, only that margins vanished and guidance must be revised. Investors are left reacting to outcomes without visibility into causes, increasing panic, volatility, and mispricing. Markets currently reward AI efficiency with higher valuations, but they are ignoring the tail risk of concentration, dependency, and automation without oversight. Just as financial markets once underestimated the risk embedded in complex derivatives, today they underestimate the risk embedded in autonomous supply chain algorithms. The silent revolution is complete. Supply chains are no longer just about moving goods. They move money, risk, and power. And until markets learn to price that reality, the next disruption won't just empty shelves. It will shake balance sheets, portfolios, and financial confidence itself. And the last one question for viewers: if AI now controls how goods move, prices form, and profits flow, who really controls the market? Companies, central banks, or algorithms? This channel breaks down the forces shaping profits, inflation, and risk before they show up in headlines. Like the video, if this changed how you see the economy, subscribe if you don't want to be the last one to understand the next shift. And turn on notifications, because in finance, timing is everything.